Before we wind up the class asaj beta today, I'll quickly revise accounting standard 10 once asaj guys, pay attention. AS10 asaj guys deals with property, plant and equipment. To understand property, plant and equipment, I'll revise guys, just pay attention. To understand property, plant and equipment, first you should know the definition of the word asset. I said asset is a resource which is within the control of the entity arising on account of a past event expected to result in future economic benefits. The most common assets that an entity can have as beta will be inventories, property, plant and equipment, investments and intangible assets. These are the four basic standards beta that are in relation to assets. Property, plant and equipment guys specifically covers only those tangible assets guys that have a benefit or that are expected to give you benefit guys for more than one financial year, more than one accounting period. They also guys should be something that is not held for sale in the ordinary course of business guys, and they should be used in the production of goods or rendering of services or for rentals to others or for administrative purposes. That sentence is common in AS26 as well as AS10. यहाँ के लिए the point that you're supposed to remember beta majorly is something that gives you benefit for more than one accounting period and is not held for sale in the ordinary course of business. Only if these points are satisfied as such guys, it will be an item of property, plant and equipment. If there are any tools, spare parts as such guys, it will also be an item of property, plant and equipment provided the definition is satisfied. It has to have a useful life of more than 1 year. Only then as such guys, it will be an item of PPE. I told you guys that accounting standard 10 as such guys is not applicable as such beta to wasting assets. Say if you have generative or regenerative as such better resources, mines as such guys, ores, mineral oils and everything, AS10 will not be applicable. AS10 as such guys also will not be applicable to any agricultural activity as such guys, or it will not be applicable to livestock. Yes or no? Producers of agricultural products guys or livestock. However, the exception here beta is that AS10 is still applicable to a bearer plant. A bearer plant is a plant as such guys which is expected to give you produce over more than one financial year. The intent is not to sell the plant itself. The intent is to sell the produce out of the plant as such better. You may sell the plant, but only at the end of its useful life. That's a bearer plant. The example of a bearer plant that we did beta was a mango tree. Are we all clear about it? You will still apply accounting standard 10 guys to any equipment that you're using for the purpose of agricultural activity as such guys, or for the purpose of those other mineral activities. Just say what if you have a crane as such guys or a tractor beta for agricultural activity? Will that still be governed by accounting standard 10? Yes. After this beta we moved on to recognition criteria. I said the recognition criteria of property, plant and equipment guys is exactly the same as an asset. 2 points. It shows something that results in future economic benefits guys, and cost can be measured. Only if these conditions are met as such beta, it will be classified as you will be able to recognize it as property, plant and equipment. Next guys, when should we apply the recognition criteria? We should be applying recognition criteria as such guys both at the time the amount is spent as such beta initially and also at the time subsequent expenditure is incurred. Are we clear? Initially when you are buying an asset or constructing an asset, subsequently as such guys when you make any modifications to that asset or you incur additional expenditure in relation to that asset. Now what is a unit of measure as such guys is not given under accounting standard 10 as such guys. Matlab you can either capitalize the entire plant or you can capitalize individual machineries depending on the conditions as such guys. Then individually as such beta, it is possible that the assets are immaterial as such guys. However, if the aggregate of all of those assets beta is still a relevant expenditure, should you apply AS10 to the aggregate of all of those items or should you be applying it individually? Aggregate of all of those items. And if an amount is immaterial as such guys, what will you do? You do not have to worry about applying the principles of accounting standard 10. You can transfer that expenditure as such beta to P&L account. Are we clear about this? Yes or no? Also guys, if there are equipments like standby equipment as such beta, what will you do? Standby equipment ka example kya hai? Generator. If you have a standby equipment like generator, it will still be an item of property, plant and equipment, though it is not intended to be used on a daily basis guys. It will be used only as and when it is required. ये important है बेटा that they need not be direct economic benefit. You can also have indirect economic benefit. That is why I gave the example of an air conditioner. Is it going to give you any direct economic benefit? No. Will it still be an item of property, plant and equipment? Anything that is indirectly going to help you in the smooth functioning of the operations as such guys will also be an item of property, plant and equipment. As far as subsequent expenditure is concerned guys, we spoke about minor repairs, we spoke about major repairs, we spoke about major inspections as such guys and part replacement. If it's a minor repair as such, guys, you will have to transfer all of those expenses incurred as such beta to P&L account. If it's a major repair as such, guys, I told you, you will have to first impair the asset, and then whatever is the expenditure that you're incurring on major repairs as such beta will be added to the cost of the asset. If there's any part replacement, check if that part replacement beta satisfies the definition of an asset or not. If it satisfies the definition of an asset, guys, replacement of a part as such beta will be added to the cost of the asset. If the replacement of a part does not satisfy, guys, the definition recognition criteria, it will be transferred to P&L account. At the time of part replacement, guys, you will have to add the cost of new part to the carrying amount of the asset by removing the written down value of the old part. If you can calculate written down value of the old part, nothing like it. If it cannot be calculated, use the cost of the new part, adjust it for inflation, work backward, and then arrive at the written down value of the part. Just say, you can see, guys, an example as such beta, that after 5 years we are replacing a part for an amount of 20 lakhs. We do not know what was the cost of it 5 years back. So we have assumed an inflation rate of 5%, worked backward as such beta, and arrived at the cost of the old part. After that also you will still have to compute written down value of that asset as such, guys. Only then you will know what is the amount to be removed and what is the amount to be added. Are we all clear? If there's any major inspection as such, guys, what are we supposed to do? Add it to the cost of the asset by removing the depreciated value, guys, of the old part, old inspection. Ye ho gaya beta regarding any subsequent expenditure. Next, initial measurement of any asset as such, guys, is always at cost. This is where we did cost of an asset first. Then we went to subsequent measurement. Cost of an asset, guys, if it is an asset that you are acquiring as such, guys, we divide that into 3 parts. What is the purchase price? What are the expenses that are directly attributable to acquisition? And what are the expenses that cannot be included? Yes or no, guys? Purchase price beta will include import, basic purchase price. It will include import duties. It will include non-refundable duties and taxes. Expenses that are directly attributable as such, guys, to bringing the asset to the present location and condition will include trial run expenditure, net of income, site preparation cost, professional fees as such, guys. Yaad aa raha hai, nahi aa raha hai beta? And handling charges as such, guys, installation expenses, all of that will be added, guys, under the second head. Third category as such beta are expenses that cannot be included. Any advertisement expenditure, promotion cost, guys, relocation cost, employee training cost, initial operating losses, guys, startup costs will not be included in the cost of an asset. Also, when you're installing the asset as such, guys, you are supposed to make a provision for decommissioning and site restoration cost. This is the amount of expenditure that you're going to incur, guys, at the time of removal of the asset. But we are incurring that expenditure, guys, only because we are installing the asset today. That is why you're supposed to make a provision for decommissioning and site restoration cost in present value terms. And what will you do with the amount of provision created? Transfer to P&L account or add it to the cost of the asset? Add it to the cost of the asset. This provision amount will keep increasing every year by the amount of finance cost. At the end of useful life, when you incur that decommissioning and site restoration cost, instead of transferring that to P&L account, you will adjust it against provision for decommissioning and site restoration cost. Next, beta, if it is a constructed asset, I said remember just 2 parts, that there cannot be any amount of abnormal losses, abnormal wastages that can be added to the cost of the asset. Also, any amount of internal profits cannot be added to the cost of the asset. What was an example for internal profit? Cement company. Proud of you guys. Cement company is using its own cement. You cannot include the market price of that inventory in the cost of building, guys. You have to include cost of cement in the cost of factory building. Are we clear? And plus interest will be included, guys, in internally generate self-constructed asset as such beta if it is a qualifying asset as per AS16. Otherwise, interest should not be included, guys, in the cost of a self-constructed asset. Then guys we did other cases beta. Jaise oh my god. Yeah. The first one beta was deferred settlement. In case payment is deferred, guys, beyond the normal credit terms, AS10 says, please do not record the asset at its invoice price. You're supposed to record the asset beta at the present value of the amount payable, also known as cash price equivalent. If the amount is payable after 2 years, and let's say the amount payable is 20 lakhs, what are we supposed to do? Record the asset at the present value of 20 lakh rupees. That is the amount at which the asset will be shown in the books of accounts. And how will you gradually increase the amount beta? Same. Finance. Jahan pe bhi present value aa raha hai beta, finance cost aayega. Are we all clear about this? Then guys, in case there is an exchange of an asset as such, guys, I said You are supposed to record the asset at fair value of the asset acquired or fair value of the asset given up, whichever is clearly evident. However, if the transaction lacks commercial substance as such, guys, when will a transaction lack commercial substance? There is no impact on the amount of cash flows of the entity, guys. There is no change in the profit generating capability of an entity, or the fair values cannot be determined. Then the book value of the asset given up itself will be the cost of the asset acquired. Normal rule, record fair value. If fair values cannot be determined or the transaction lacks commercial substance, then you will have to record the incoming asset, guys, at book value of the asset given up, outgoing asset. जो भी book value of the outgoing asset है बेटा, that itself will be the cost of the asset acquired. Are we clear? Subsequent measurement, guys, we have two options. This is an accounting policy, not an accounting estimate. Option is given to us. We can either follow cost model or we can follow revaluation model. Under cost model, an asset will be disclosed at its original cost minus accumulated depreciation minus accumulated impairment losses. Under revaluation model, it will be shown at revalued amount minus subsequent impairment losses, subsequent depreciation. You can follow revaluation model, guys, or cost model. Investment property that is covered as such, guys, under accounting standard 13, for that we can only follow cost model. We cannot follow revaluation model. So if you own a building which is for rental purpose, you can only follow cost model. If you own a building beta which is to be occupied for your business, then it is property, plant and equipment as per AS10. You can follow cost model or revaluation model. If an entity intends to follow revaluation model, there are few points to be kept in mind. Revaluation model, if followed, should be for an entire class of asset, not for a single asset. So, जैसे land beta, all the lands have to be revalued or all the lands have to be shown at cost. All the office buildings, all the factory buildings, different class of assets. Revaluation as such, guys, should be done on a fairly regular basis. If the prices of the assets are volatile, please carry out revaluation every year. If the prices of the assets are relatively stable, once in 3 years. Yes or no, guys? 3 to 5 years better, so that the market prices as such, guys, are as close as possible to the carrying amount of the asset. The book value should be as close as possible better to the market value, fair value of the assets. Now, when we are revaluing an asset as such, guys, you will have to see whether there's an increase in the value of the asset or decrease in the value of an asset. If there is an increase in the value of the asset, you will have to transfer it to revaluation reserve. If there's a decrease in the value of an asset, you will debit it to P&L account. After increase, if there's a subsequent increase as such, guys, again same. After increase, if there's a decrease, first adjust against revaluation reserve. The excess amount, if any better, will be debited to P&L account. If there is a decrease in the value of the asset, we know that we have debited to P&L account. After decrease, if there's a subsequent decrease, what will you do? Again debit to P&L account. After decrease, if there is an increase as such, guys, to the extent of earlier decrease, you can credit to P&L account. The excess amount beta will be transferred to revaluation reserve. What will you do with the balance lying in revaluation reserve? It cannot be utilized for any purpose whatsoever, guys. As and when the asset is sold as such beta, you can transfer it to general reserve. Option 2 kya hai? To the extent of increase in depreciation, we can transfer revaluation reserve to general reserve every year. There is nothing that can be adjusted against revaluation reserve except impairment loss. Now that you have done with accounting standard 28, guys, you know if there's an impairment loss, it should be first adjusted against revaluation reserve if any, and the balance will be debited to P&L account. As per AS10, kuch nahi kar sakte. Simply transfer it to general reserve. After this, guys, revaluation, treatment of revaluation reserve, guys, we moved on to depreciation. Before depreciation, beta, we did component accounting. I said if an asset as such, guys, comprises of significant, if an asset which has significant parts as such, and those significant components as such, guys, are subject to different depreciation method or they are subject to different useful lives, you should be recording each of those components separately and you should depreciate them separately. You cannot depreciate the entire unit as such, as a single asset. The example beta covered for this was aircraft industry. I said the engine can have a different useful life, the outer body can have a different useful life, the inner interiors beta can have a different useful life. Interiors may not have a useful life of more than 10 to 15 years, guys. Outer body as such beta can have a higher useful life, engines will have even higher useful life. So all of them beta will be accounted separately and be depreciated separately. As far as depreciation is concerned, guys, it says, to compute the amount of depreciation beta, you need what is the depreciable amount, what is the useful life, and then what is depreciation method. You need depreciable amount, you need useful life, and you need depreciation method. The standard says which depreciation method that you follow beta should obviously depend upon the pattern in which you're deriving the economic benefits as such, guys. We are no one to tell you whether you should follow straight line method or written down value method. Can I have different depreciation methods for different assets? Definitely yes. Depreciable amount is nothing but the difference, guys, between the cost of the asset and its residual value, or carrying amount of the asset and its residual value. You should commence depreciating the asset as soon as the asset is available for use and should not wait for the date the asset is put to use. Yes or no, guys? Useful life of the asset, guys, is nothing but the period over which economic benefits are expected to be derived by the entity. If the physical life of an asset is 30 years, can I take the useful life to be 10 years? Yes, if I intend to sell the asset at the end of 10th year. I gave an example beta where, let's say that you're shifting to a new city for a temporary period of 2 years or such, guys. You buy a car, you know that you will be selling the car at the end of 2 years. Now when you're depreciating the car in your books of accounts, you will obviously not take the entire useful life of the car. You should take a useful life of only 2 years. But you'll also take residual value as at the end of 2nd year. You will not take scrap value of the car. Won't the residual value be higher? This will automatically result in correct amount of depreciation. So when will you stop depreciation, guys? When the depreciable amount does not exist, matlab residual value is already more than the carrying amount of the asset, you should obviously stop depreciating the asset. Or if the asset is retired from active use and is held for disposal, then also you should stop depreciating the asset. Hereafter you will start stating the asset at lower of carrying amount and its NRV. If the asset is retired from active use and is also held for disposal. Are we all clear about this? If there's any change in depreciation method, any change in useful life as such, guys, or any change in residual value of the asset, all of them are considered as change in accounting estimates. Will you account for them prospectively or retrospectively? Prospectively, guys. Are we clear? An asset will be de-recognized as such, guys, as and when it is actually sold, or where there is no future economic benefit expected. That means even by selling the asset, you are not going to get any amount. Then obviously you will have to de-recognize the asset. You will not wait better till the asset is actually disposed of. So on mein aa raha hai, nahi aa raha hai? Any doubt in related to this? We've also covered, guys, what will happen if there's a change in the estimate of provision for decommissioning and site restoration cost. I said recompute the amount as to what should be the opening balance. Let's say the original balance original estimate was 1 lakh. Revised estimate is 1,50,000. You will recompute what is the present value of 1,50,000, compare it with the existing provision. This will be the change in provision. Whether the change in provision will be adjusted to the cost of the asset or whether it will be adjusted against revaluation reserve will depend on whether you're following cost model or revaluation model. If you are following cost model, change in provision will be adjusted to the cost of the asset. If you are following revaluation model, don't you think the asset is already appearing at fair value? This is where it will be considered as subsequent revaluation. Anything that is resulting in a gain, add it to revaluation reserve. Anything that is resulting in a loss, either reduce from revaluation reserve. If there is no revaluation reserve, debit to P&L account. Are you all clear about this? Yes or no, guys? This is what we have covered, guys, in accounting standard 10 recognition, change in accounting estimates of kuch. So on mein aa gaya? That's the end of this session and the end of the class as well. Online students ending the session. Alright, guys, let's quickly revise accounting standard 15 beta employee benefits. This standard as such, guys, covers the accounting for all forms of benefits as such beta that are payable to the employees. I'll talk about it, guys, don't worry. These benefits can be in cash, can be in kind as such, guys. It can be wages, it can be salaries, it can be any other allowance as such, guys, that is being given to the employees. The employees that are covered under this standard as such beta can be part-time, can be full-time, can be temporary, can be permanent. We also include directors of the organization. We include all management personnel also. As long as there is an employer-employee relationship that is established as such beta, it will come under accounting standard 15. The only thing that is not covered under AS15, guys, are any payments that are given to the employees which are based on the share price of the organization. It can either be in the form of share or it can be based on the share price of the organization. That is called as a share-based payment. Also, we should know, guys, as to what is the difference between contract of service and contract for service. Only a contract of service, guys, creates a employer-employee relationship. There need not be a formal employer-employee relationship as such, guys, even if there is no employment agreement entered into, but then you know that the employer-employee relationship has been established as such, guys, it will still be governed by AS15. A contract for service, guys, is a contract where we render services for a consideration. There is no employer-employee relationship. I told you that such payments as such, guys, are accounted as consultancy payments. They are not accounted as salaries. Now, for the purpose of this standard, we divide all of these. Usse pehle beta I told you the major point of this standard is to ensure that we record expenditure on accrual basis and not on payment basis. Because employees might work for the organization for a considerably long period, there might be benefits that you're giving to the employees on a later date. The outflow is coming on a later date. But you are giving them those benefits, guys, not because they are retiring or they are quitting the employment. It is because they've worked for the organization for a very long period. That is why you will have to book that as an expenditure as such, guys, as and when the employee is rendering service. That is accrual basis. So for this purpose, we divide all the employee benefits into 4 categories. But we have short-term employment benefits, long-term employment benefits, post-employment benefits, and termination benefits. Short-term employment benefits are those benefits that are payable, guys, within 12 months from the balance sheet date. Long-term employment benefits are payable after 12 months from the balance sheet date. For short-term employment benefits, they can cover things like outstanding wages, outstanding salaries, profit-sharing plans, bonuses, guys, or compensated absences. Long-term employment benefits can also cover profit-sharing plan over a longer period, can cover long-term compensated absences. Can there be organizations where the leave can be carried forward for more than 1 year? That will become a long-term compensated absence. It will not be a short-term compensated absence. Then beta, we have post-employment benefits, which covers things like gratuity as such, guys, pension payments, medical cost. And then there will be termination benefits, guys, that comes when there's a voluntary retirement scheme arising. Now, talking about the accounting as such, guys, for short-term employment benefits, I said, if there is outstanding wage, outstanding salary, please provide it on accrual basis. The only thing that you will have to separately know as such beta is the accounting for short-term compensated absences. In case the leave beta can be carried forward to the next year, employees who are rendering a higher service in the current year, guys, might end up rendering a lower service in the next year, though the amount of salary that is being given to them, guys, will remain same. That is why, in case the leave is accumulating as such, guys, they will have to make a provision in respect of the payment that you're going to make in the next year, though the employee is not going to render service. He worked an extra amount as such beta in the current year, he will render a lesser service in the next year. You are going to pay him in the next year, but he is not going to render service to that extent. So for this beta, we divide accumulating leaves as such, guys, into 2 categories beta, called as vesting and non-vesting. A vesting compensated absence beta is where the leave can be carried forward and can be encashed by the employees. If the leaves are vesting as such, guys, nothing doing, you will have to create a provision for 100% of the leave that is being carried forward. If the leave is non-vesting, you create a provision only for the estimated amount of leaves that will be carried forward and utilized in the next year. For this also, I told you in questions, they might give you LIFO method. That is, when the employees are availing leaves in the subsequent year as such, guys, they will first utilize the leaves of that year. Only the excess leave will be out of the carried forward leave. There was this question that we did, out of 100 employees or such beta, 92 employees will avail only 5 days leave, but 8 employees will avail 6.5 days. So only for that extra 1.5 days or such beta, in respect of 8 employees, you had to create a provision. You never had to create a provision in respect of all of those 100 employees. Are you all clear about this? If the leave cannot be carried forward, that it is non-accumulating as such beta, then there is nothing to be done only. Because you are not going to pay them for any lower work as such, guys, in the next year. Are we clear? Then, guys, we moved on to the next concept, which is post-employment benefits. The first thing that we should know under post-employment benefits is that how are we going to pay the employees? It can either be by way of defined contribution plan or it can be by way of defined benefit plan. Under a defined contribution plan, guys, what is the, we basically better avail the services of a third entity. I gave you the example of LIC gratuity scheme. So if we are a smaller organization, we will not afford to run our own plan as such better. This is where, what are we going to do? Take a scheme as such beta from LIC. LIC will consider all the employee base of the organization, their average age as such, guys, past attrition rates sab dekhega. Based on that, they will advise us on the amount of contribution that we will have to make to LIC. It's like how we take life insurance from LIC. Here we are taking a gratuity scheme from them. So we will have to make a contribution to that LIC gratuity scheme as such, guys. Once that contribution is done, we have to forget it. Who will be responsible to pay out all of those benefits to the employees? LIC will be responsible. Are we clear? Because we are not liable as such, guys, to make any additional payment on a later date. The only expenditure that will arise in the given case is the amount of contribution that we are making every year. So what will be the accounting for this? Whatever contributions that we are making will be debited to P&L account every year. Nothing will come in the balance sheet as a liability. Nothing will come in the balance sheet as an asset. Because there is no obligation on our part on a later date. We just have to make contribution today and forget it. Defined benefit plan mein beta, we are defining what is to be paid out to the employees on a later date. We will have to ensure, guys, that funds are available to that extent. Whether we actually have made investments or not, did we set aside money or not, no one cares about it. You will still have to give all of those benefits to the employees. That is called as a defined benefit plan. It is in respect of defined benefit plan that we have to create a provision, guys, based on estimates. For defined contribution plan, nothing. Directly debit to P&L account to be contribution. Now, when it comes to defined benefit plan as such, guys, I said, you will have to create a provision based on projected unit credit method. PUCM tells us better that though the benefit will be payable on a later date, the benefit accrues uniformly over the year of service. That is why you are going to book it as an expenditure, guys, on a uniform basis. However, because the amounts are still payable after a certain period of time, you are supposed to record them in present value terms. We took an example where 10 lakhs was payable to employee after 5 years. So the share of expenditure of each year is 2 lakhs. Instead of you booking 2 lakhs as expenditure directly in year 1, we booked present value of 2 lakhs as expenditure, also known as current service cost. This provision, guys, amount will be slowly increased every year by something called as finance cost. Similar to provision for decommissioning and site restoration costs. You're recording provision in present value terms, but you will keep increasing the amount of provision by the amount of finance cost year after year. So these are the two components, guys. This will go and every year you will book current service cost, you will book finance cost. This will go and sit under your provision amount, and this provision account, there's an official name given called as provision for defined benefit obligations, DBO, defined benefit obligation. Now, when we are computing this provision amount as such, guys, there are a lot of estimates that will be required to compute the amount of likely outflow that is going to occur on a later date. Because you're not talking about one employee working for the organization, guys. There can be thousands or lakhs of employees working for the organization. We will have to know when are they going to retire, what is the amount of salary that they're going to draw in the last year, for how long are they going to survive, what is the amount of medical expenditure that they will be incurring. So these assumptions are broadly segregated into two categories called as demographic assumptions, guys, and financial assumptions. A demographic assumption, guys, can be in relation to mortality rate, life expectancy as such, guys. It can be in relation to early retirements as such, guys, disabilities of the employees. Financial assumptions, beta, can be investment rates, can be your discounting rate as such, beta. It can be medical inflation, cost of medical expenses. So salary increments, guys. All of these will come under financial assumptions. The provision amount can change, guys, whenever any of these assumptions are changing. If there is a change in provision amount on account of a change in assumption, it will be called as actuarial gain or loss. Whatever actuarial gain or loss is arising as such, guys, what do you do with it? You transfer it to P&L account immediately. After this, beta, we spoke about plan assets. We took also an example, guys, wherein we changed the discounting rate and arrived at the amount of actuarial gain on account of a change in discounting rate. Then, beta, we moved on to plan assets. I said organizations will also want to, beta, fund their obligations by setting aside money every year. This investments that you are making as such, guys, by setting aside money are called as plan assets. In this plan assets also, guys, every year there will be a certain amount of contribution made. Every year some or the other employee might keep retiring, so there will also be benefits paid out. If there are benefits paid out, you will reduce it from your provision amount, you will also reduce it from your asset amount. So you reduce your PVDBO, you also reduce your plan asset amount. And then, guys, the total return that you're generating on your plan assets, you divide them into two parts. One is expected return, the other one is actuarial gain or loss. Any excess return or deficit return that you make as such, beta, from the level of expected return will be accounted as actuarial gain or loss. Even that has to be recognized in your P&L account immediately. Yahan pe, beta, I said the questions are important. They might give you that the rate is 10.25%. And on the opening value of the fund, you will directly consider 10.25%. After 6 months, that is during the middle of the year, You will have contribution, you will have benefit paid out. I said do not directly compute at the rate of 10.25%. Recompute what is your semi-annually compounded rate, and on that semi-annually compounded rate as such beta, you will compute the benefit for the remaining period. So you divide your total return as such beta into expected return, guys, and actuarial gain or loss. समझ में आ रहा है नहीं आ रहा है guys? After plan assets as such, guys, we moved on to the concept of past service cost. Yes or no? As far as past service cost is concerned as such, guys, it is in case an organization is announcing a new scheme as such, guys, or is increasing the benefits, guys, under an existing scheme, or is increasing the number of employees covered by an existing scheme, that provision amount will increase. This increase in provision, guys, is called as past service cost because it relates to service that was already rendered in the past. If the employee is already entitled to benefits, guys, even if he retires today, you will have to recognize this past service cost immediately. If the benefit is not accruing immediately, guys, and the employee will be entitled to benefit, guys, if he works for a few more years, you will have to amortize this uniformly over that remaining period. However, in order to ensure that you arrive at the correct amount of finance cost, I said you first include the entire amount in PVDBO, then also reduce unrecognized past service cost. That is why, guys, we write PVDBO minus unrecognized past service cost. Are we clear? They might not question you on past service cost. They might just give you some curtailment scheme under which they will mention unrecognized past service cost. As far as presentation in the balance sheet is concerned as such, guys, you will have opening, whatever is the PVDBO as such beta provision amount. From that you will reduce unrecognized past service cost, and then you will reduce fair value of plan assets. Usually this amount will be positive, meaning you will have a higher amount of provision and a lesser amount of investment that was made. If the amount is positive, it is a net liability. You will disclose it as a liability in your books of accounts. Will come under long-term provisions as such, guys. If the net amount is negative, it means you have made a higher investment than the amount of provision. So this is your asset. You can recognize this as an asset subject to following two, lower of the following two amounts. First amount beta is the amount that you've actually determined, or guys, present value of benefits in the form of refunds or reduced contributions. Are we clear? ये amount question में दिया जाएगा, जैसे the previous examination question that you have solved some time back, they directly give the amount in the question, guys. If you cannot recognize it, you basically when you cannot recognize it as an asset, it basically means you will be rolling out a higher amount of benefit to the employees. So you have to increase the provision amount. After past service cost as such, guys, we moved on to curtailment and settlement. Curtailment arises as such, guys, when you're reducing the benefits that are to be given to the employees, guys, under a scheme, or you are reducing the number of employees that are covered by the scheme. Doesn't matter what is the reason, a curtailment results, guys, in reduction of the amount of provision. Settlement arises when you're discontinuing a plan. Either you will not give them anything as such, guys, or you will not give them benefit hereafter as such better. Whether it is curtailment, whether it is settlement as such, guys, does not matter. If there's any reduction in the net amount of liability as such beta on account of curtailment or settlement, it has to be transferred to P&L account immediately as a gain. Are we clear about this? All that they will do beta is give you what is the amount of liability before, what is the amount of liability after. You just compare both the amounts and then you see, guys, what is the net reduction in the amount of liability. Is that clear, guys? After curtailment and settlement as such, guys, we moved on to the last three parts as such, guys. One was reimbursement asset. Yeah, there. I said in case an entity has a defined benefit plan, but then it is liable to receive either the entire amount as such, guys, or a part of the amount as such beta as a reimbursement from a third party, then that reimbursement can be recognized as an asset if and only if it is virtually certain that you are going to realize the amount. Also, that reimbursement asset cannot be deducted from PVDBO like plan asset. It should be recognized separately on the asset side, guys. Next, will gratuity scheme that you take from LIC be accounted as a defined contribution plan or a defined benefit plan? Normally, it is defined contribution plan because the liability, guys, will not be on our head. In case we will still be liable for any shortfall that may arise as such, guys, then it becomes a defined benefit plan, and whatever contributions that you're making to LIC will be accounted as plan assets. After that bit, I gave you notes about long-term employment benefits. I said long-term employment benefits are accounted in the same way as post-employment benefits, guys. If there's any amount of past service cost as such, guys, you will have to recognize it immediately. Then we spoke about termination benefits, VRS. In case an entity has made a VRS scheme as such, but announced a VRS scheme, then you will have to create a provision based on the estimated number of employees who are likely to avail the VRS scheme. If such estimate cannot be made as such, guys, it should be recognized as, it should be disclosed as such, but as a contingent liability. Are we clear, guys? Yes or no, beta? That is all what we have covered as such, guys, under this standard, nothing else. ठीक है? All right, beta. Online students, और एक standard revise कर देना है. 1 second. Online students, stopping the session. So guys, what are the homework questions given? No homework questions. कुछ भी नहीं दिया. We've covered accounting standard 24 the other day, beta. We have defined what's a discontinuing operation. We have covered the examples of activities, guys, that are not discontinuing operations. Just say discontinuing operation, mein, beta, I said there are 3 points to be met, guys. It has to be, kya, guys? A component, beta, that the enterprise is disposing of in its entirety or by piecemeal, guys, or through abandonment. Second point, guys, it should be either a separate segment or it should be a significant component of a segment, guys. And third point, you should be able to distinguish it operationally and for financial reporting purposes. Are we clear? And then, beta, we took examples of activities that will not be considered as discontinuing operation. I told you guys, if there's a gradual phasing out of a product line or evolutionary phasing out of a product line, it cannot be considered as a discontinuing operation unless it also involves sale of all the assets as beta related to that product line. It is very much possible for an entity, guys, to shift their production facilities, guys, from one product line to an other product line. Obviously, the demand of one product line reduces, the demand of another product line increases. You will shift or allocate as beta your production facilities to the other product line. Yes? Then, beta, I also said there are 4 activities, guys, that by in itself will not become a discontinuing operation. Only if they satisfy the first points as beta, they will be considered as a discontinuing operation. Just say one of the points as such, guys, related to that, beta, was gradual or evolutionary phasing out of a product line. Second point as such, guys, even if you are discontinuing abruptly several product lines within an ongoing line of business. The example for this, beta, that was covered was biscuits or chocolates, guys. A company is basically, beta, dealing with multiple varieties of chocolates. They're discontinuing few chocolate lines. They're not selling any of the assets. If you're shifting your production or marketing facilities from one location to another location, guys, even that will not be a discontinuing operation. Even if you are shutting down any production facility, guys, or any other business function for the purpose of cost savings, guys, or productivity improvements, that will not be considered as a discontinuing operation. We took the examples of outsourcing your distribution network, guys, for shutting down any business function and then outsourcing it, guys, for the purpose of productivity improvements. Now, after the definition of the word, common examples for discontinuing operation, beta, would be sale of a division, would be demerger as such, guys. Okay? Now, after this, beta, we spoke about initial disclosure event. Initial disclosure event will be earlier of 2 dates, guys. The first one, beta, is there is binding sale agreement entered into, guys, for substantially all of the assets. Second one, guys, whoever is the competent authority, beta, either the board of directors, guys, or the other competent authority has already approved a detailed formal plan and has also made announcement of the plan. Only if they make announcement of the plan as such, beta, it will be considered as the initial disclosure event. When we say detailed formal plan, beta, I told you that your plan should compulsorily identify what are the assets to be disposed of, what is the expected method of disposal, what is the expected timeline as such, guys, what is the expected cash flow that you're going to generate. Only then it will become a detailed formal plan. Otherwise, it will not be a detailed formal plan. Sound mein aa raha hai, nahi aa raha, guys? After this, beta, we have learned about disclosures. I said whenever the initial disclosure event has occurred, the first financial statements that you're going to present, beta, after this initial disclosure event should consist of few disclosures. Those disclosures are, guys, a description of the discontinuing operation, the segment under which, guys, this discontinuing operation was reported, details and nature of the initial disclosure event, guys, and then all the financial disclosures. Under financial disclosures, you will have assets and liabilities related to balance sheet. You will have P&L related revenue, operating expenses, pre-tax expenditure, tax expenditure, post-tax profit. Cash flows related, you will have cash flow from investing activities, operating activities, and financing activities. And also, guys, all of these disclosures are required to be given under notes to accounts. On the face of P&L, you will have to divide your overall profit into two parts. How much is profit or loss, guys, from continuing operations? How much is profit or loss from discontinuing operations? Proud of you guys. इसके बाद में, guys, additional disclosures में, if the entity has already entered into an agreement as such, better to sell the asset, disclose the selling price or the range of selling price, and what is the expected cash flow carrying amount of the asset. Or if you have already sold the assets, then disclose what is the amount of pre-tax profit or loss that you have made and the related tax expenditure. You will have to keep updating these disclosures as such, guys, till the discontinuing operation is actually disposed. Even if it is disposed on, let's say, 2nd of April 2026, when you're presenting your annual report for the year 26 to 27, you will have to give disclosures. It should be including the period in which the operation is being discontinued. Are we all clear about this, guys? Yes or no? And beach mein beta, if you're presenting your interim financial statements, which I'm going to cover in the next accounting standard as such, beta, I will talk about what are the disclosures to be given. You will have to give, beta, if there was any change in the amount of disclosures that you made earlier. Just say last financial statements mein you did not enter into a binding sale agreement, but now you have entered into a binding sale agreement. Give those disclosures as to what is the price or the range of prices. Any doubt in this, guys? Yes or no? I said the common question that comes from AS24 beta can be either in relation to you shifting your production facilities from one product line to another product line. जैसे कल बता रहा था बेटा मैं वो dish washing से cloth washing बात जो भी है, you are only shifting your production facilities from one product line to another product line, guys. That will not be considered to be a discontinuing operation, or from commercial vehicles to passenger vehicles to be a. But if you are entering into an agreement or you've decided that you're going to sell all the assets that are related to that product line, then it will become a discontinuing operation. Or the other question beta that can come in the examination can be in relation to initial disclosure event. They might give you dates and ask you to identify when is the initial disclosure event occurring. Are we all clear about this? 1 second beta.